Well, hello everybody. This is Tom Simmons coming to you from my backyard in Shelburne Falls, and this is your first much anticipated video for Business 105, personal finance, or personal financial literacy. And the reason I wanted to address you on with this video first is because we're about to enter a topic that is, like many financial topics, is emotional, is controversial, is not completely understood by a lot of people, and that is the notion of credit and the proper use of credit. Credit brings up a lot of instant thoughts based on what we have used credit for in our past. And there's two different extremes when we approach the use of credit. When we borrow and then pay back money at interest in order to obtain the goods and services that we want right now. One extreme says that credit is bad, that it should never be used, and I'm staying away from it. And the other extreme says, hey, credit's a cheap, easy way just to get things you want, and then you end up running up your credit cards and paying off minimum balances every month and never getting ahead. Let me suggest to you that both extremes are problematic. Let's start with the one that I mentioned first, and that is being afraid to use credit. I want you to imagine a farmer who is able to put aside $1,000 a year, every year, into savings. And this farmer would love to get a tractor because right now he and his wife and children are doing all of the work in the fields by hand. Very labor intensive, very hard on the body. And he wants a $40,000 tractor. But he absolutely refuses to borrow, refuses to use credit, believes that credit is somehow bad or wrong. Well, if the most he can save is $1,000 a year, and the tractor costs $40,000, how many years is it going to take him to save to buy that tractor? 40 years. He's probably going to be over 60 at the time he's able to buy that tractor for cash. And some people would say, well, then if he can't afford the tractor, then he just shouldn't have the tractor. But look at it from this perspective. It may well be that if he had the tractor now, he could raise 3 times the amount of crops that he raises right now. Or he could plow more land. Or he could plow succession crops, 2 or 3 crops a season instead of just 1. And maybe he'd be able to do that in less time. And it would be better for his health and his family's health. And he would have greater income as a result. In fact, it's very possible that the income to be derived by having the tractor now would be greater than the interest cost he would be incurring for borrowing money now. And in that case, it would make a lot of sense to borrow money for the tractor. This actually is a problem in many underdeveloped countries, where there is no banking system, there is no mechanism to borrow funds or to capitalize, as the word is often used, in order to increase production or improve the quality of life. When you think about it, governments do this all the time. And again, it's not necessarily a bad thing. If a government discovers that there's a bridge that is cracking or unsafe, they want to fix it. And the best and most efficient and quickest way to do that is not to close it down and then hold bake sales or raise taxes for the next 20 years in order to raise several $1 million to fix the bridge. The way that most governments operate is to sell bonds, which essentially is asking the public for a loan. They take a loan, they do the repairs that need to be done right now, and then they pay that loan back with tax receipts. That's an efficient way to handle a health problem right now. When I lived on Martha's Vineyard back in the 1990s, one of the issues the town of Oak Bluffs incurred in the business district during the summer was that every business was on its own septic system. And Martha's Vineyard is a town of 8,000 to 10,000 people in the winter, but on 4th of July weekend, there's over 100,000 people on the island. And that means the septic systems get overloaded. And for 1 or 2 summers in a row, it meant that the septic systems in downtown Oak Bluffs, for all the businesses, began to overflow. And at one point, raw sewage was actually floating down Circuit Avenue, the main street in Oak Bluffs. Well, the town decided it needed to build a sewage collection and treatment system for downtown Oak Bluffs. And they didn't decide to raise taxes a little bit and save for the next 20 years in order to have enough money to do that. They decided to borrow the money, build the system, and then pay it back over time, because it made sense to deal with that right now. So there's a use for credit, and there's a positive and productive use for credit when it makes sense to have the money now. Anytime you have taken out a loan for education now, it probably has made sense to you without doing the calculations, because you realize if you waited and saved until for the next 20 or 30 years to have a full amount of a college education, then you might not be willing to go back to school at that point. Or if you need a car now, you may need the loan now. Sometimes when mortgage rates are very low, as they currently are, it makes sense to take that mortgage now, rather than wait until a time when it's going to cost you even more. So I don't want to enter the discussion of credit and borrowing and interest with the notion that it's innately bad, because it's not. It's in many ways it's innately good. It enables us to use money now that we don't particularly have. Another place where we may operate on credit are those of us who have flexible spending accounts for health payments. A flexible health spending account means that I have up to $5,000 a year that I can spend on health costs, and I can pay it back through paycheck deductions over time. So that if I have a serious medical issue in January or February, I don't have to say, well, I'm just going to wait until it gets worse, and I'll save the money up, and I'll go in November or December when I have the money and get myself fixed. Because at that time, it may be too late, or it may be a much exacerbated problem. It makes sense to take care of it now and then pay that back through periodic payments. So there is a place and a role for credit. Places, societies that use credit tend to have higher standards of living, tend to have better infrastructure, tend to have better health standards, because we're able to use it now. The flip side of that, however, is to use it indiscriminately or to use it incorrectly and to not understand the payments that we are obligating ourselves to. It's very common for people to get credit cards very early in life, often in college, when they're fresh out of high school, and to see this as free money. As we saw in our last lesson, money now is worth more than money in the future. So we get a credit card, and it's got a credit limit of $500, $1,000, $1,500 or more, and we say, oh, great, now I can go out and buy this and that and the other thing that I really want. And we begin to treat the credit card as if it's money in the bank that we can now spend. And of course, it's not. One of the biggest dangers, once we begin using credit like this, is to use all of our credit. We're going to see in our next lesson that it's good for our credit scores to have some credit. But one of the worst things we can do is to use all, even a majority, of our credit. And when we max out our credit cards, meaning we've got $2,500 in credit and we spend all $2,500, very often we run into trouble. We don't have the ability to make major payments on that credit card. We don't pay it down. Or the credit card company, the bank, sends us a statement saying, hey, your minimum payment's $25. And we say to ourselves, well, as long as I can pay $25 a month, I'm meeting my obligation and I'm doing the right thing. You're going to see in the homework lesson that I've assigned for this lesson that when you take a large credit card bill and you make the minimum payments, you're not paying that bill off. You are not getting ahead. A credit card that is as low as $2,500 with a typical interest rate, and today those interest rates run anywhere from 15 to 29%. But if you take an interest rate that's somewhere in the middle and you have a maxed out credit card of $2,500 and you make the minimum payments and you think you're doing a good job because you're making those payments and you're making them on time, it might shock you to learn that it will probably take you more than 20 years to pay that card off. And the amount of money you will spend in interest may equal or even exceed the amount of money you actually borrowed. So if you borrowed $1,000 for a car repair or a vacation or a new sofa, by the time you've paid that off, you may have paid $3,000. And worse than that, the extra $2,000 you just paid is money you could have used on something else, for something else that you needed, and you have lost the ability to use that money for that purpose. Another problem we often get into, in addition to simply making those minimum payments and never getting ahead, is to actually exceed the credit limit, because we charge the card high, and then we get interest payments on top of that. And then we miss a payment and we get a late payment fee. And pretty soon $29 or $28 or $35 late payment fees, missed payment fees, overlimit fees begin piling up. And rather than owing $2,500, now we're seeing ourselves owe $3,000 or even more. And sometimes the credit card companies even make it easy for us to do this by saying, hey, we'll increase your credit limit by $300, $400, $500. And we keep inching up and owing more and more, and it never gets paid. And so then we may fall into another trap. We take a cash advance on credit card B in order to make the payment on credit card A. Then when credit card B becomes due, we don't have the cash, so we take a cash advance on credit card A, robbing Peter to pay Paul. We think we're doing okay because we're making payments, and in fact, we're incurring more interest and more fees and getting further behind and delaying the ability to pay off those cards. Now, some of you have indicated, and congratulations, that you don't have credit cards, or you've paid them off, or you don't use them. But there's a good chance that you've used credit for some other purpose. A car loan, an education loan, a mortgage, or some other purpose that you might not even think of. A doctor's or a dentist's bill where you're charged interest on a monthly basis if you don't pay off the full amount. That, in essence, is a loan. They have given you a loan and you're paying it back. So loans figure in many different aspects of our life, and it is a fact of life for the vast majority of us. What we need to do is to learn how to use it effectively and efficiently and for our purposes and not for the purpose of the lender. As we saw in our last lesson, money now is worth more than money in the future. And those institutions that loan you money on the card for your education, for your car, they know that. So when they loan you money now to make that purchase, they know that in order to make it worth their while, they need to make money on what they are selling you. And many people aren't aware that places such as car dealerships are not really making money on the car itself. They're making a good deal of their money on the loan that they are making to you. Because money now is worth more than money in the future. So if they loan you money now to purchase the car, they need to find a way to make that up. If you look at the annual reports of some of the major heavy equipment operators and auto companies in the United States, Caterpillar, John Deere, Kubota, or a motorcycle company such as Harley-Davidson, if you look at their financial reports, one of the things you will find is that a significant portion of their profit and their income comes not from the profit they make on selling the product, but from the profit they make on the interest they charge customers, because they provide not only the product, but they provide in-house financing. This is where you as the consumer need to have a little bit of savvy. If a dealer, for any loan, says to you, well, you can have this car or this educational loan or this mortgage or this tractor or whatever it is, and your minimum payment's going to only be $120, $200, $230 a month, this should be a red flag to you. In fact, very often they will say to you, what can you afford to pay per month? You will say, well, I really only want to pay $150, but I really want this car or I really want this toy, so I'll say $200 a month. That's the most I can pay. They will work backwards, and in many cases, they will find a loan or a financing package that, in fact, you will be able to make that minimum payment. But the problem with making the minimum payment is that by making the minimum payment, you are maximizing the amount of profit that the lender is making off of you. And you have little chance of getting ahead or reducing that obligation. I'd like to challenge you to forget about the notion of, what do I owe? What's the minimum payment? What's my car payment? What's my mortgage payment? What's my educational loan payment? Forget about that concept. Making that payment is the payment that maximizes the profit the lender can make. It is not the payment that helps you pay off your debt. You need to think beyond and above that. The exercise that I've posted in the course documents section is an exercise to help you understand how significant the difference is when you decide that you're not going to make minimum payments. You're going to make more than the minimum payments. You are going to increase what you pay on any single one of those loans that I've just mentioned. When you increase the amount you pay on those loans, you will decrease the amount of time it takes to satisfy that obligation, and you will save hundreds, if not thousands, and in the case of a house mortgage, tens of thousands of dollars in interest that is now in your pocket for you to spend. Another tool you may consider, in addition to making the minimum payments, making more than the minimum payments, is to pay off one loan at a time if you have several loans. And then once you've paid off a small loan and you've wiped your hands of it and it's over, do not then say to yourself, oh, this is great because I got rid of that credit card debt, so now I have $70 or $100 more a month to spend on toys. Don't do it. Use that same payment to increase the amount you pay off another debt or another credit card. The quicker you pay off those debts, the more money you will save, the more money you will have to spend on the things that you actually do want. Now, once again, I'm going to go back to the beginning here. I'm not saying credit is bad. Credit can be very good. It can help you get ahead, but it doesn't help you get ahead if you don't do it wisely. Most credit counselors will suggest that you use credit and then pay it off every month, if you can. You may use one card simply for gasoline purchases, knowing that you're going to go through $150 or $200 in gasoline a month. So you put that cash aside. You make the charge on the card, and when that bill comes in, you pay it in full with the money you've put aside for that purpose. Many credit counselors will also tell you, don't charge something unless you really have the cash behind it to pay for it, and you're simply delaying when you have to lay that cash out. Now, we all know there are emergency situations when you feel you have to make that payment now. Medical and car repairs are two of the biggest. But again, if you use that credit wisely and don't max out the card and pay more than the minimum and understand this problem of interest and fees accumulating, you'll be able to use and manage the credit in a wise manner that will help you get what you need now, will not get you into trouble, and as we'll see in the next lesson, will actually improve your credit score so that should you need credit in the future, you're in the catbird seat. You're in a good place. So I'm going to encourage you to do the exercise that I've posted. Look at the numbers. Compare the numbers as to what happens when you pay minimum versus pay more than minimum, and then apply it in your own life. Use the calculator that I've posted to analyze your own credit card, mortgage, education, medical, or auto loans, any other loans you may have, and see how you can make a difference in your own life, and you can take charge and not simply be handing money over every month forever and ever to lenders. I hope this has set a context for what you're about to do in this lesson, and I hope you'll be able to use it in a real and significant way in your own life to help you increase your financial position, to help you improve your financial position, and to help get you out from under debt, which is emotionally scarring and scary and stressful for every one of us. Thanks. Good luck with the lesson.